Okay, Bismillahirrahmanirrahim. Let's start with the question that is Harvard Ford Company June 18 question. That is a question for final account. Let's read out the question and the requirement of this question, and we are going to solve this question in Excel format. So there's a trial balance given, a short trial balance in which the assets, equities, and liabilities details are given. For few requirements, few adjustments are there. I think five adjustments in this question, and the requirement is calculate the adjusted profit for Harvard Company for the year ended 31st December 2007. What does it mean? It means there must be some draft profit in which the further adjustments are required. Let's find out, is there any draft profit or the profit and loss or the retained earning? So yes, there is a draft profit which is given over there in which the adjustments are required. And definitely the adjustments which are required are from 1 till 5. Then the second requirement is prepare a statement of changes in equity, and the third requirement is the statement of financial position, that is the balance sheet. Let's start with the adjusted profit, because we know that once we are able to calculate the adjusted net profit, the other requirements are definitely linked with the adjusted net profit. So start with that. We have a given profit, that is the draft profit, which is 2250. Draft profit is 2250. Let's start with that one. That is the profit. That is the profit as per trial balance, or we can say that that is the draft profit. Draft profit. So that is the draft profit, and draft profit is that is 2250. That is the draft profit for the year. Now further adjustments are required. Let's read out the adjustment number one. What is the adjustment? The following notes are available or relevant. On 1st January 2007, Harvard Ford Company issued $80,000 104% convertible loan notes. Hold on. Let's recall from which standard that the adjustment is given, and that is definitely from IFRS 9 convertible bonds. Okay. 80,000 convertible loan notes were issued. $100 the par value, 4% is the coupon rate. The loan notes can be converted into equity shares on 31st December 20x9, that is 20x7, x8, and x9, that is for 3 years, or redeemed at par on the same date, or the debentures will be paid off at the par value. An equivalent loan without the conversion right would have required interest of 6%, that is the market rate or the effective rate. Interest is payable annually in arrears on 31st December each year. The annual payment has been included in finance cost for the year. It means interest or the finance cost have been recorded, but for the coupon amount. But we are sure about it that interest is recorded for the effective rate and not for the coupon rate cap. So let's move on. The present value of $1 receivable at the year, and that is the present value is given for two interest rate, that is the 4% and the 6%. And we know that 4% is the coupon rate and 6% is the interest rate. Let's go with this adjustment and work out for the interest amount. So the working one for the convertible bonds. Convertible bonds. So how we're going to account for this one? So we know that first of all we have to find out the finance liability, that how much the finance liability, and for that we need cash flows. Is it? We need cash flows. That means the first column is year, and the second column is the cash flow. Second column is the cash flow. Third column is the present value, that is a discount factor. Discount factor. So we are having this convertible bond for 3 years, that is year 1, year 2, year 3. Now what is that cash flow? cash flow, definitely the amount which actually the company has paid, and the amount which the company is paying is the coupon amount which the company actually is paying to their investors. So what is the amount of par capital? Yeah, par value. The amount of the par value is 80,000. Let's apply the formula. 80,000 multiply by 100, multiply by 100, and the 4%, multiply by 4%. So the 3,20,000. 3,20,000 is the 3,20,000 is the coupon amount or the interest paid. Let's work out on the millions of figures. So 320 is the cash flow for the year one. 320 is the cash flow for year two as well. And make it sure, please, that for year three it's not 320. Reason is, in the last year, the company definitely is not going to pay only the coupon amount, but will also pay the par value, that is the redeemable value. So what is going to be the redeemable value? This would be 8,000 plus 320, as the redeemable value would be the par value. It is already mentioned in the question. Or redeemed at par on the same date. It means on the last year the company will pay off the 8320 amount to the investor. Now let's find out the present value. That the present value, because these are the future cash flows and we need to calculate the present value. And the discount factor that we are going to use is the 6%, that is the market rate. So what is the amount? That is the amount 320 multiply by, and the discount factor for the year one is 0.943. 0.943. So the present value is 301.76, and same goes for this. The present value is 0.890, 0.890, and multiply by the present value is 0.840, 0.840. So this is the present value. Let's total this one. Let's have a sum of it. So the sum is 7575.836. That is what, that is basically the liability, or we can say that that is the finance liability, or we also can say that that is the initial measurement. That is the initial measurement. And let's work out for the subsequent measurement. How we gonna work out for the subsequent measurement? That is the year opening balance, effective rate, coupon, that is the interest paid, and the closing balance. The closing balance year, that is the year 1, 2, and 3. Opening balance 7575.36, or we can refer the cell directly. And the effective rate is 6%. 6% of that amount. 6%. And the coupon amount is the par value. Par value, that was the 8,000 multiply by 4%, that's 320, and the closing balance would be 7575 plus 454 minus, that makes 709, 7709.88. So that is the further recognition or the subsequent measurement of the finance liability at which it will be recorded at the balance sheet. So now what adjustment is required? Is there any need to prepare the complete table? No, there is no need to prepare the complete table. We are counting for 1 year, so there is no need to prepare or complete the table for next 2 years. Now, what amount of interest should have been recorded? It should have been recorded for 454. And for what amount the interest has been recorded? That's for 320. It means for the difference amount. As it is already said that an equivalent loan conversion right have been required, 6% interest is payable in arrears. The annual payment has been included in the finance cost. What does it mean? It means the coupon amount is recorded in the finance cost. However, the interest that should have been recorded in the P&L, it should be 454. So what adjustment is required? Basically we need to calculate the difference amount That is 454 minus 320, that is 134. 134, we need to calculate, we need to adjust that 134 amount to the PNL, as this expense or interest has not yet been recorded. So adjustment is required. What accounting entry would it be required? That is the PNL debit. PNL debit, it means the interest expense debit, and finance liability credit. That is with the amount of 134. That is with the amount of 134. This adjustment would definitely be required. That is PNL debit and finance liability credit. So let's adjust this profit. That is the convertible, or we can say that the finance cost. Finance cost, for reference purpose, we are gonna to link working one, that is 134 is required to be adjusted, that is minus 134. Minus 134 is required for finance cost. Okay, is there any adjustment required from this one? Yes, one adjustment will also be required once we are preparing the balance sheet, as we are going to include the finance liability at 7709.8, because this is the subsequent measurement. Okay, now let's move on for the another adjustment. Adjustment number two: during the year, company entered into a contract to construct an asset for the customer, satisfying the performance obligation over the time. The contract had a total price of $14 million. The cost to date of $1.9 million are included in the above trial balance. Cost to complete the contract estimated at $7.1 million. At 31st December 2007, the contract is estimated to be 40% complete to date. However, Ford company also has received 1.4 million from the customer, and is shown in the trial balance above. So now what adjustment is required? First of all, let's recall the standard from which it is related to. It is definitely related from IFRS 15. So working to that is the construction contract. Construction contract. Now let's work out for this construction contract and how we are going to do this. So first of all, we need to include the construction contract revenue for the year, revenue or the profit for the year. So what is the method or the pattern? First of all, we account for the total price or the total revenue for the contract. Total revenue for the contract. What total revenue is expected? The total revenue or the total price is 14 million. That is 14,000. And what is the total cost for this contract or the construction? Total cost is, that is the cost incurred to date is 1.9, and the further cost that is required, that is 7.1. So it means 1.9, that is 1900, plus 7.1, that is 7100. It means total cost which is required to complete the contract is 9 million. So the profit, that is the total profit from the contract, is 5 million. Why we are going to calculate the total profit? Reason is, if the company is making the loss on this contract, then we need to account for the whole loss. As per IS 37, it would be considered as the onerous loss. But right now the company is making a profit on this contract, so we won't be recording the whole profit in the PNL. We will be recording the profit as per the construction, as per the contract is completed, on the basis the contract is completed. So 40% is the contract is completed. So revenue which we are going to account for in the PNL is the 40% of the revenue, total revenue, as 40% of the total revenue. So 14,000, and we are going to calculate the 40%, that is 5,600, and the cost which we are going to account for is definitely again the 40%. So the to be profit to be recognized is 5,600 minus 3,600, that is 2,000. That is the profit to be recognized, that is 2,000. So we are going to do construction profit. We're going to do refer working 2 for this, and the amount is 2,000. Okay, so that means that construction profit is going to increase the profit. So we are adding up this construction profit. Is there any adjustment required for this construction contract? Yes, for the adjustments are required, but that is not for the P&L, but for the balance sheet. As you guys definitely remember that we include the head of account in the balance sheet, that is the contract asset. So we are gonna to account for that contract assets. So how do we are going to calculate the contract asset? The formula for calculating the amount of a contract asset or the contract liability is the cost incurred to date. Cost incurred to date, that is the cost incurred to date was 1.9 million, that is 1900. And the profit recognized or recognized profit, what is that amount of recognized profit? Recognized profit is 2000. Recognized profit is 2000. And the cash received or invoiced is deducted. Cash received, that is deducted. And the cash received is I guess 1.4 million. 1.4 million, that is 1400. So the construction or the contract asset 1900 plus 2000 plus 1400, that is 2500 is the contract asset that is going to be recorded in the balance sheet. We are not going to account for this one in the PNL, or we are not going to account for this one in the adjusted or the profit. We are going to record this contract asset in the balance sheet. So this was the adjustment we have made it. That was the working to for the construction asset or the construction contract. Let's move on to the adjustment number 3. That is the company made a 145 issue, bonus issue on 31st December 20x7, which has not yet been recorded in the above trial balance. Haverford Company intends to utilize the share premium as far as possible in recording the bonus issue. Let's recall the bonus issue. Bonus issue, that is the company is basically transferring the one equity account to another equity account. That means company is transferring their share premium account, that is the capital reserve, into the ordinary share capital. So that is the basically a paper activity, that is the issuance of a bonus issue, bonus shares. So how we are gonna to record this one? Working 3 for bonus issue. First of all, we need to identify that how much bonus issues are being, how much bonus shares are being issued. So let's calculate the criteria for the bonus shares is 145. Let's calculate the number of shares the currently company have. Ordinary share is 20,000. Ordinary share capital is 20,000, and the number of shares is 20,000 as well. So first of all, bonus shares to be issued. Bonus shares to be issued, that is the 20,000. 20,000 is the total number of shares which the company have, and divided by how much bonus shares we are gonna to issue, that is 145. Is it? That is 145. That is one more bonus shares for every 5. That is divided by 5 and multiply by 1. So 4,000 bonus shares are to be issued. 4,000 bonus shares are to be issued, and the value of bonus shares to be value, yeah, or we can say that the par value of shares is $1. $1. So if you're going to multiply, that is the value of bonus shares, that is 4,000 multiplied by $1, that is $4,000. That is the value of bonus shares that is to be issued. Now how we are going to account for this one? First of all, for this purpose we are going to use the share premium account. If there is no share premium account, definitely we are going to issue the bonus shares through retained earning. Is there any share premium account? Let's see. Yes, we have share premium account. That is, the share premium account is for 3,000. It means share premium 3,000 will be utilized. However, we are issuing bonus shares for 4,000. So what we are going to do? We are going to transfer that amount from retained earning account, retained earnings account, retained earnings account what is the balance amount, that is 1000, and ordinary share capital will be credited. Ordinary share capital will be credited with the amount of 4000. So that accounting entry is gonna to be prepared. Okay, so one more thing, is there any hit on the PNL item? Is there any hit on the PNL item? So there is no hit on the PNL item. It means net profit will not require an adjustment for this one. There is no adjustment required in the net profit. Let's move on to the another adjustment. That is the adjustment number four. Company property had previously been revalued upward, leading to the balance on the revaluation surplus as 1st January. Definitely, there is gonna to be some revaluation surplus. Yes, there is a revaluation surplus, and the amount is 800. 800 is the revaluation surplus. Okay, so let's move on. 800 is the revaluation surplus. So revaluation surplus. The property had a remaining life of 25 years at 1st January 20x7. At 31st December 20x7, the property was revalued at $16 million. No entries have yet been made to account for the current year depreciation charge or the property valuation at 31st December 20x7. Howard Ford Company does not make annual transfer from revaluation surplus in respect of the excess depreciation. It means the company have decided to transfer the revaluation surplus into the retained earning account once the asset is disposed of. So what adjustments are required? Number one, we need to calculate the depreciation for the current year, and number two, the revaluation surplus should also have been recorded, and the revaluation surplus has taken or accounted for at the year end. So first of all, let's calculate the depreciation for the year ended 31st December 20x7, and the depreciation method is definitely straight line if nothing is mentioned. Depreciation method for the property, we have the amount of property of 18,000. That is the carrying amount. 18,000 is the carrying amount or the revalued amount. We can say that we need to calculate the depreciation. So let's calculate the depreciation working for property. Property uh, that the carrying amount for the property is carrying amount for the property is 18,000. 18,000, and life or the remaining life which is given in the question, that is the remaining life is 25 years. 25 years the life. So let's calculate the depreciation. 18,000 divided by 25, the depreciation is 720. What adjustment is required? That is PNL debit and asset or property credit. Property credit with the amount of 720,000. 720,000, that is the debit and credit. So that adjustment definitely will hit the profit and loss account, that is the profit, depreciation expense, that is 720. Okay, now is there any other adjustment required? So the revaluation is also required. Now the carrying amount at the year end, carrying amount at the year end would have been 18,000 minus 720, that is the depreciation for the current year. So the carrying amount is this, and the revalued amount or the market value of the asset is 16 million. That is the market value is 16,000. So market value is 16,000. Carrying amount is 17,280. Market value is 16,000. It means there is no upward revaluation but the downward revaluation. There is a downward revaluation as the value of the property is decreased by 1280. Now, for what we are going to do, just recall the IS 16. Is there any previous revaluation surplus? Yes, we do have some previous revaluation surplus, and that is for 800. So what are we going to do? That is the downward revaluation. So how are we going to account for this one? First of all, we need to reduce the revaluation surplus to the extent as there is a previous revaluation, and that is around 800. So what now? How the balance will be transferred? So property value is being decreased by 1280. That is the fact. But we could only transfer 800 to the revaluation surplus account. The remaining would have been recorded or would have been transferred to the PNL as an impairment loss. So it means PNL would be debited or impairment loss. We can see that impairment loss will be debited with the balance amount. And the balance amount is 1280 minus 1800, that is 480. It means that particular adjustment is required. This adjustment is going to hit both the PNL and the balance sheet. Right now we are looking after the PNL item, that is the profit. So it means 480, the profit will be reduced by 480. Profit will be reduced by 480 on account of the impairment loss. So impairment loss will be recorded. Impairment loss will be recorded for 480, and the reference should have been given for this one. That is the working for both the depreciation as well. That is the working for, and for this one as well, working for, that is known as what, the impairment loss. So we have accounted for this impairment loss as well, and depreciation for the year as well. Now the last adjustment which is required, that is, it has been discovered that the inventory of 0.39 million had been omitted from the final inventory count in the above trial balance. It means we need to record this inventory, and once we are recording the inventory, what adjustment is required is, we need to account for the inventory in both the P&L and the balance sheet. P&L and the balance sheet. So what accounting entry is required? That is merchandise inventory debit and P&L credit. That is gonna to increase your profit with the amount of 0.39 million, that is 3900. We are gonna to account for this inventory in both the merchandise inventory, that is in assets, and as well as in the P&L. And in P&L we are going to increase the amount of inventory or increase the amount of profit. So these were the adjustment which were required. So let's have a total. Is there any other adjustment? No, no further adjustments are there. That is sum as a 6816. 6816. Oh, wait. I think there's certain error. Inventory is 0.39. 0.39 million. So this is going to be 39. Where is the inventory? That is 390. 390, I guess. Yes. The amount should have been 390. So this should have been 390. So adjusted profit is 3306. That is the adjusted profit. Now what is the next requirement for this question? The next requirement for this question is, we are going to prepare the statement of changes in equity and then the statement of financial position. So let's prepare first of all the statement of financial position, and then we'll prepare the statement of changes in equity. So statement of financial position, and definitely as at 31st December 20x7. First of all, let's account for the assets, then non-current assets. And non-current assets, we do have property, for which we have worked out, and the value of property is which we have right now calculated. So the recoverable amount, or we can say that the market value is 16,000. Is it? because the appreciation for the year is already been recorded, and at the end of the year the property was revalued to 16,000. It means the property value is 16,000. Is there any other non-current asset? No further non-current asset could be find it out over there. So no non-current assets are there. So that is the total non-current assets. Total non-current asset is 16,000. Now let's move on to the current asset side. Current assets. So current assets, we do have different current assets. Uh, that is the inventory, first of all, inventory, and inventory which we have calculated, the ending inventory. So inventory we do have in the trial balance is 4310. 4310 is the inventory, and further inventory which we have recorded or which we have adjusted, that is 390. So 4700 is the ending inventory, and the other asset we do have account receivable. Account receivable or the trade receivables. The amount of trade receivables is that is 5510. 5510, yes, 5510. And the another asset we do have, that is the cash for 10320. And is there any other asset? Yes, one more asset, that is the contract asset which we have calculated. Contract asset for which we can refer even a working, that is contract asset is 2500. Contract asset is 2500. We could even refer to the adjustment or the working as well. That is working 2. Working 2, that is the working 2 we have. So that is the contract asset. And is there any other asset we do have? So the current assets are inventory, account receivable, cash, and contract asset. There is no other current asset which we could find out in the trial balance. So let's total with the current assets. Some, so that is the total current assets. Total current assets 23030, and the total assets is this plus non-current, that is 39030. Now let's move on to the shareholders equity side. Shareholders equity, and shareholders equity. First of all, ordinary share capital. Ordinary share capital. The ordinary share capital which is already given in the question is $20,000. Further, bonus shares were also issued, and the bonus shares which we have issued is the amount 4,000, for which the capital is increased. 4,000 ordinary share capital. Okay, one more thing is we have issued convertible bonds during the year. And what does it mean? It means we are going to record the financial liability and equity as well. That is also known as what, split accounting. So there is always an equity component or the equity element. 8,000 amount was received, and against which 7575 was a liability. It means 424 is going to be the equity part, and it is not ever restated. It will be mentioned or it will be recorded forever. So 424, or we can say that 425 is the amount of equity, that is convertible equity, or we can say that equity option. We can say that equity option is the amount it will be recorded in the equity, that is 425. We can refer to that cell as well. 424.65. So that is the amount which we have recorded as an equity. Any other component of equity? Yes, share premium. But is there any share premium? There is no share premium, as we have already utilized all the share premium for the issuance of bonus shares. Revaluation surplus, there is no revaluation surplus anymore. Reason is we had a downward revaluation, and for which we have transferred all the revaluation surplus and we have cancelled out all the revaluation surplus. Now what's next? Is there any other? Yes sir, there is a part of retained earning account, and we need to work out for this one. That is gonna most probably the working six. So we need to work out for this one. That is the working six. So how we are going to work out for this one? Let's start with this working six. That is the retained earning opening balance. Retained earning, retained earning balance BD, that is the opening balance which is given in the trial balance, and that is the retained earning balance is 6270, I guess. Am I right? Yes, 6270. 6270. 6270 is the retained earning opening balance during the year. Adjusted net profit is transferred. Adjusted net profit, and the adjusted net profit which we have calculated, that is 3306. That is going to be added up in the opening retained earning balance. There is a dividend paid is the amount. Dividend paid, the amount of the dividend paid is 3620. That is minus 36020, as it will reduce the retained earning balance. And is there any adjustment in the retained earning? Yes, definitely there is an adjustment of bonus issue. Bonus issue, we have reduced the retained earning account. We have reduced the retained earning account. So let's find out with where is the retained earning account? Yes, this one, with the amount of 1000. We are going to reduce this retained earning balance by 1000. That is the bonus issue. Okay, is there any other is there any other adjustment which is required in the retained earning? Let's find out. Is there any entry prepared in which the retained earning account is affected? No, no such account is there. No such account is there. It means the balance on the retained earning account is 4956. So that is the retained earning closing balance. That is the balance CD, which is going to be presented in the financial statement. We're going to do that for the cell 4956. That is the retained earning balance. So any other equity component? No, there is no further equity component. So total shareholder total shareholders equity. Total shareholder equity is the sum of all, that is 29380.64. That is the total shareholder equity. Now let's move on towards the liabilities side. Liabilities and the long-term liabilities. Long-term liabilities. So long-term liabilities we do have in the trial balance is the loan notes, 4% loan notes. The amount which we are going to record in the balance sheet is the subsequent measurement, that is on the basis of amortized cost. That is the 7709.8. That is the loan notes. And any other long-term liability which we have? Long-term liability, no, we don't have any other long-term liability than the current liability. We do have current liability for 1840. is the current liability which is already given in the question. So any other liability which we have? No, we have no other liability in this question. We have no other liability. So the current liability is 9 total current liabilities. Now let's calculate the equity. Total equity, that is current liabilities plus long-term liabilities and plus the shareholder equity. Okay, we have done it. Okay. What we have done it. That is the long-term liability total. That is the total of long-term liability. Okay, long-term liabilities. Okay, we have not yet accounted for the current liabilities. Okay, current liabilities, current liabilities, and what current liabilities we are having? That is 1840. That is the current liability. Okay. Now total equity is current liability plus long term liability plus that is the shareholder equity. So 8930, 38930. So the total equity is 38930 and the total asset is 39030. Something went wrong. Something went wrong. The equity and the asset side is not equal, and that is the major concern for every account student. Let's see, is there anything which we have omitted? Hmm. Waiting earning balance we have taken into account for, and okay. The interest, that is the interest for the year, is P&L debit and liability credit. So the interest expense we have recorded in the P&L, but we haven't accounted for in the balance sheet. So the current liability, that is 1840, 1840, and plus 134 or 135, 134, that is 1974, 39064, and the asset side is 39030. Now that is a little bit different for the rounding of one. So that was the balance sheet. Now start up with the equity section, that is the statement of changes in equity. How to account for the statement of changes in equity, that is the most important part. How to account for the statement of changes in equity. Statement of changes in equity. Now, always remember, once you are preparing the statement of changes in equity, what you have to do, that is, you have to account for, or I can say that just look at the balance sheet component. Look at the balance sheet side, that is the shareholders equity. What if you have any, whatever the component are there, that is the mandatory part of your changes in equity. So it means the components which we are having, that is the first of all description, or the columns which we have, that is the description. Share capital, that is the ordinary share capital ordinary share capital, and retain earning, definitely retained earnings, uh, share premium account as sorry, convertible option, that is also the part of your shareholder equity. And share premium, although the closing balance is zero, but still it was the part of your balance sheet earlier. Share premium account, revaluation surplus. And if is there any other equity side or the equity component is share premium, revaluation surplus, retained earning account, and that's it. There is no as such further account balances. So the columns which we have prepared, how we are going to identify that how many columns are going to be prepared? Just look at the balance sheet, the components which we are having in the shareholders equity. Definitely they are going to be part of the statement of changes in equity. And further, what else, what other columns are required, we can identify from the trial balances. So now first of all we are going to put the balances as on 1st January 1st January 20x7. Ordinary share capital, the ordinary share capital which was given in the question is 20,000. 20,000. Retain earning balance that was given in the question, that is 6270. 6270. Convertible option, there was no closing balance as this was issued, or this was created in the mid of the year. Share premium balance was that is 3000. 3000, and revaluation surplus balance was 800. So that was the opening balances, and finally we can have a total. So total, we can apply the formula, that is sum. So that is the closing balance, that is the total. Okay, now what adjustments we have made so far? That is the adjustment for the bonus issue, in which we have credited the capital, or we have increased the amount of capital with the amount of 4000, is it? Let's recall this one. 4000, we have increased the amount. Yes, that is increased the amount of 4000, and reduce the retained earning as well as share premium. So 4000, we have increased the 4000, we have increased the share capital amount, and retain earning we have reduced 1000, that is minus 1000. And for share premium we have reduced 3000. This has nullified the balance of share premium account, and no adjustment was in revaluation surplus, or we can say that the convertible option. So let's apply with the formula. Okay. Now, what other adjustment we have made during the year in the equity section? That is for revaluation or downward revaluation, in which we have definitely had a impact on revaluation surplus, and we have reduced the revaluation surplus by 800. We have reduced the revaluation surplus by 800, as there is no impact on other account balances, because in that adjustment we have debited the revaluation surplus, and debited the P&L account as well as credited the asset account. So on equity side we. Okay, now what other adjustments are required? The other adjustment which is required, that is the dividend paid, which the dividend which you have paid during the year, that is the amount already given in the trial balance. So the dividend paid is 3620. Yes, it is 3620 dividend paid, and definitely the dividend is paid out of retained earning. So minus 3620. 3620. And is there any adjustment required in any other account balances or any other column? No. Reason is the entry for the dividend is retained earning, debit, and cash or bank credit. So no adjustment is required in the capital account or the convertible option or the share premium. So let's total this row as well. Okay. Now another adjustment which we have made during the year is for option shares, or we can say that the convertible bonds. Convertible bonds, we definitely classify equity component. Let me show you the equity component. That is a 424.64. That is the equity component we are going to require to adjust or to record in the change in the equity section. So option equity 424, and we are going to add this one 424. This will increase the equity part. And any other adjustment which we have made? Yes, that is the transfer of adjusted profit. Adjusted profit which we have transferred in the shareholder equity. So adjusted profit which we have transferred in the retained earning account, that was I guess, what was the amount? 3306. 3306 was the amount. 3306, that will increase the amount of retained earning or the value of retained earning. So these were the adjustments which we have made in the equity section. Let's sum all of these columns. uh, So that is the sum for all these columns. The balance on the share premium account would definitely be zero. Revaluation surplus account will also be zero. And the balance on the retained earning, that would be 4956. And the capital account 24,000, that is 2607. 26074 is the total of the equity. Is the total of the total. That is the total of equity. So okay. This is the total statement of changes in equity which we have prepared. Always remember, the main item or the main part is that you have all the balances, all the figures over there on your spreadsheet. Formatting, that is the bold, italic, outline, table format. These are all the secondary requirements. So just try to fulfill the primary requirements, that is to calculate, that is the calculations and the figures and the values and the workings. These are the primary requirement that you need to follow. Other secondary requirements definitely would definitely give a edge to your presentation, but always focus for the primary requirement first. So that was the question of definitely it was a lengthy question. And remember, always remember, once you are attempting the final account question, it would take time. Try to do practice as much as you can so that you have a good grip on your spreadsheet. Thank you so much.